Thank you. Thank you. It's an honor to be here tonight and give this Gideon Rosenbluth lecture. So I'm going to talk about income and wealth inequality, evidence, and implications. So let me motivate the topic of measuring inequality. So the first thing I want to say is that inequality matters because the public cares about it. That is the way we are going to evaluate how well we are doing in society is really by comparing ourselves, with others in society. And that's really the reason that makes, the study of inequality important. And that implies that for us, academics who study and measure inequality, we need to provide transparent inequality measures that can then enlighten the public debate. So the goals here are to understand the drivers of inequality trends and the effects of public policy on inequality. So let me mention a few key concepts that you need to understand to follow what I'm going to present. So income is what you earn over the course of, say, a year. It's a flow, and it's the sum of labor income and capital income, where labor income is what you earn out of working, and capital income is the returns you're getting from your wealth in the form, of bonds, stocks, housing, etc. And wealth is really a stock accumulated from savings and inheritances you may have received from your parents. So in aggregate, labor income is slightly less than 3/4 of total income. That leaves, remaining big quarter, 25 to 30% to capital income. And wealth is about, the stock of accumulated wealth is about 4 times annual income, which implies, that the annual return on wealth will be on the order of 6 to 7%. And wealth inequality is always much higher than income inequality, because in any society, even the most equal ones, the bottom 50% families own very little wealth. The last thing I want to mention is that all advanced economies, the governments in all advanced economies, tax a significant fraction of total income. So in the US, which is on the low end of this tax level, we tax about 1/3 of market incomes to fund transfers and public goods. So that's a very important point. That is, in our advanced societies, we share a very large fraction of our incomes. It can go up to 50% and above in some countries in Europe, Canada being around 40%. And as a result, disposable income inequality after taxes and transfers is typically much lower than market income inequality. So today, I'm going to talk only about market income inequality, that is before government taxes and transfers. So a very simple way to measure inequality is to ask the question, what share of total market income goes to various groups in the population, such as the top 10% families, top 1%, etc. And so, as Tom Lemieux said, with many collaborators, we've used individual income tax statistics to create long time series of income concentration. And really, the individual income tax statistics are the only source that are going to cover very long time period, because income taxes have existed for many years, almost a century in Canada, and that are going to capture well top incomes. So we've analyzed now, in what we've called the World Top Income Database, in red, about 25 countries. So that really started in France with Thomas Piketty, who carried out the first study. Then with Thomas Piketty, we studied the United States, and just a couple of years after, about 12 years now, with Michael Veal, we did study Canada. So today I'm going to present mostly numbers about the US and Canada, but we'll talk about other countries as well. Obviously, that's a large collective effort. Many researchers have been working at putting together these data. So let me start then with first simple facts, which is on this chart. You have the time series of the share of income pre-tax going to the top 10% families in the United States, from 1917 to 2012. So what you can see is that this graph has a big U shape with high levels of income concentration before World War II, with the top 10% taking, something like 45% of total income. A drastic drop that actually is really concentrated in the years of World War II, and then in the decades after World War II, a much lower level of income concentration, with the top 10% getting, only a third of total income. And then perhaps what is the most striking in this graph is, starting in the late 70s, a steady rise, that has been, with some fluctuations, but a pretty steep slope upwards, so that by 2012, the top 10% is actually getting something like 50%, half of total income, a level as high as it's ever been over that time period. Now, what about Canada? So Canada, for the top 10%, I don't have as long a time series, but it does look like a similar pattern. There was a big income inequality reduction during World War II. Then Canada had a level of income concentration actually higher than the US, in the high 30s, but lower than it been before. And you can see as well that starting a little bit after the United States, in the early to mid 1980s, there has been a significant increase. So that today, Canada is perhaps in the low 40s. So not as extreme an increase, but a significant increase as well. So Canada has less inequality than the US today. This chart shows you, that 50 years ago, it was the reverse. Now, the second thing I want to discuss about the US numbers is to show you that this big increase in the share going to the top 10% is really due to what happens at the very top of the distribution, namely the top 1%. So the way you can see that is on this graph that splits the top 10% into three groups. In black, you have the top 1%, then in blue, the next 4%, and in red, the next 5%. So the sum of those three make, the top 10%. And what is striking in this graph is that if you look at the most recent period, the vast majority of the increase has come from the top 1%, that goes from less than 10% to over 20%, with some gains in the blue series, like 3 points, but you see much smaller and actually very little gain for the red series. So really the increase in inequality comes from what's happening at the very top, and that's why the tax statistics are critical, because we economists cannot capture well the top 1% using traditional survey data. And so actually the higher you go, the more extreme is the change. So here, he's the top 0.1% that goes from less than 3% in the 70s to over 10% in recent years. So the second thing, the last thing I want to mention on the US income inequality series is about composition. So this chart is the same as this one in the sense that it's the top 0.1%, but it also shows you the composition of those incomes in terms of salaries in stripes, business income, which is a mix of labor and capital income, in dashed, and then capital gains that are a form of capital income. And so what's striking on this graph is that early on, before World War II, when top incomes were really high, they were mostly capital income, which means that at the top of the distribution, you had people deriving their incomes from their wealth, very little from labor. In contrast, in the big increase that we've seen, you can see that a significant chunk of that is due to a surge in salaries and also business income. So although, top incomes are as high as they were a century ago, the composition seems to have changed substantially, with really very high labor incomes competing and replacing, to some extent, high capital incomes. So now, so this then brings us to wealth. So what can we say about wealth concentration? So first thing, so this chart shows you the share of wealth owned by the bottom 90%. So 90% of the population in the US, they own, about a quarter of total wealth because wealth is so concentrated. But there are interesting time series there as well. That is, you do see first what we call, a democratization of wealth, with the wealth share, going to the bottom 90% increasing from 20% or less, to about over 35% in the 80s. So that's wealth democratization due to the development of pensions, private pensions, and also the rise in home ownership, followed by an erosion in middle class wealth. Now the share of wealth going to the bottom 90% has fallen to something, like less than 25%, and that fall has really been due to a large increase in debts. So mortgages that eat up, your housing wealth, and also other forms of debts, in particular credit card debt and student loans. And the fall has been really dramatic, actually, during the Great Recession and afterwards. So again, contrast this with Canada, where we don't have as good data on wealth, but the share of wealth going to the bottom 90% in Canada looks more like it's 45 to 50%, which is not as big a change over, the last 30 or 40 years. But I want to caution that the data from Canada here comes from surveys, and it's not clear, that captures very, very well the very wealthy families in Canada. So the flip side of that, of those wealth numbers for the bottom 90%, is the share of wealth going to the top 0.1%, and it has this shape, of a big U as well, and it shows you that wealth inequality has also been increasing a lot in the United States, so that in recent years, you see that the level of wealth concentration, total wealth going to the 0.1%, 1/1000th of the population is over 20%, and that is about as high as it was, before the Great Depression. So this shows you that the United States has very high top labor income, and now is having, also a high level of wealth inequality. So if you want, the US combines now both very high labor income inequality and wealth inequality. Now, I've shown you, numbers for the US, a little bit for Canada, but it is interesting for us to use the evidence we've gathered in that World Top Income database to understand better the trend. So here I'm showing you the top 1% income share for the US in black that we've already seen, then the United Kingdom in blue, and Canada in red. And so what is striking on this chart is that all three countries follow a very similar pattern, of high levels of income concentration before World War II, a drastic fall, that in the case of Canada is concentrated also really during the years of World War II, then a lower level of income concentration, and in the recent period, an increase. So you can see that the increase in Canada and the UK is not as big as in the US, but it's still pretty significant. So you see in Canada, it goes from 7.5% to it reached a peak, of almost 14%, with a slightly lower numbers after the Great Recession. So you might say, maybe this is a universal pattern. However, now if I show you evidence from other countries in continental Europe and Japan, you get a different picture in the recent period. For the first part of the century, it's the same in the sense that all countries have very high levels of wealth concentration, but then there is a big deconcentration, that takes place following the history of each country. So for Japan, also World War II is a critical event. And interestingly, in those three countries, you can see that the increase in the recent decades, it's much smaller. It's non-zero in the sense that in all three countries you do see an increase, but you see the two charts are on the same scale. It looks very small relative to what has happened, in these other countries. Okay, so the first result that data, established is that all countries that are rich today had actually very high income concentration 1 century ago. So even a country like Sweden, that now is the example, of a very equal society, had off the chart inequality levels, a century ago. And that inequality was really driven by wealth, so top incomes were high because there were lots of very wealthy people with very high capital incomes. And so all of you, of course, have heard about the book from Thomas Piketty. And really, Thomas Piketty has been looking at that data for many years, and that's really what drove his pessimisms about inequality. In most of history, inequality is very high, and the low levels of inequality seems to be an exceptional moment, that happened in Western society. So all countries experienced sharp reduction in income concentration during the first part of the 20th century, primarily due to the fall in top capital incomes. The idea being that war and depression shocks hit top capital earners. The drop follows each country's specific history, and then government policy responses, so the most important one being, regulations, especially financial regulations, and the development of progressive taxation. Income taxation and inheritance taxation are going to make that drop permanent. With very progressive tax rates, it's very hard for new wealth to reconstitute itself and also pass into next generation. Now, the result number 2 is that the recent surge in inequality is driven first by a surge in top labor incomes, which then fuels wealth inequality in the case of the United States. Interestingly, that surge in top labor incomes doesn't happen everywhere, and certainly not at the same level or to the same extent. And so that simple, big difference across country, you remember the English-speaking countries versus continental Europe or Japan, tells you that you can't blame it all, to technological progress or globalization, that more or less, should affect all advanced countries in similar ways. It's not the unique explanation. It has to be, that globalization and technical change interacts with institutions specific to each country, and some institutions, are better able to absorb the shocks and are not going to create as much inequality. So that's why policies play a key role in shaping inequality as well. And I will discuss some of that in the remaining of the talk. But the key question that we'd like to address is really, do those big gains that we've seen, going to the top 1% in countries like the US and Canada, reflect the fact that the top people are just more productive, or do they reflect the fact that top people are better able to extract, some of the fruits of the economic process, and maybe that comes at the expense of the rest of the population? So before I do that, let me show you a few more numbers about Canada, and especially to understand what's different and what's similar in the United States and Canada. So here is the top 0.1% income share in the US and Canada. So you can see a pretty similar pattern and a big increase in the recent period, but not as big in the case of Canada. Now, here is the same figure, for Canada, showing you the composition of the top 0.1%, this time starting in 1946, because we don't have data before that, but going all the way to 2010. So you can see that in Canada, 60 or 70 years ago, top 0.1% incomes were divided equally between salaries, business income, and capital income. Now, you can see that actually virtually all of the big increase that we see in the top 0.1% is really driven much more than in the US by a surge in salary. So really the reason that income concentration has increased so much in Canada is really because Canada has seen the emergence, of very highly salaried workers, so typically executives in large companies. Okay, and so you can see contrasting this one with this one, you can see that in Canada it's much more labor income than capital income. And actually, a direct way to see that is this time to look specifically at wage income. So wages and salaries. So here you have the chart of the share of wage income going to the top 1% in Canada and the United States. And it's incredible how similar those two series are. So you can see that Canada has followed the US in terms of having a large increase in labor income. It does look like Canada doesn't yet have as much of an increase in capital income concentration and wealth concentration as in the US. So another striking thing in the case of Canada is that this big increase in wage income concentration has not been the same everywhere in the country. So here is a contrast we did with Michaelville that was striking. We took the francophones in Quebec and the other chart being, Canada excluding Quebec, and shows you, for both parts of Canada, the share going, to top 1% wage earners in each part. And you can see that Canada excluding Quebec has a large increase in wage income concentration. In contrast, the francophones in Quebec see a much smaller increase. I mean, they start from a lower level, but even from that lower level, they have less of an increase than Canada excluding Quebec. Okay, so this really, to summarize, the surge in top incomes in Canada is almost fully driven by the surge in top wage incomes. Top wage incomes in Canada follow closely US top wage incomes, and top wage incomes among francophones in Quebec have increased much less. So how do we make sense of those results? Well, it really does look like income inequality increase in Canada is explained by the combination of the fact that top wages increased in the US and that there is labor market mobility integration between the US and Canada. In other words, if US companies start paying their executives a lot, Canadian companies have to increase wages and salary for these people as well because they might possibly move to Canada. And that happens less in Francophone Quebec, perhaps because there the market integration is not as big. And as Tom Lemieux would be able to tell you, that competition is felt even at the level, of economics department. UBC has to compete, with the big schools in the US, and obviously, that drives up salaries. Okay, so in other words, for Canada, really the cause looks like it's the big neighbor, the United States. Now, let me then go back to the US and the international evidence to try to understand why is it that the US had such a big increase, in inequality. So this is the top 1% income share in the United States that we've already seen. And just to show you why tax policy likely plays a big role, I've overlaid in that chart the top marginal tax rate, on this axis in red here. And so you can see that the US starts with very low top tax rates and big increases during World War I, then low rates again, and then big increases, after the Great Depression, with levels of top tax rates that are almost unbelievable by today's standard, but the US had a top tax rate above 70% from the 1930s all the way to the early 1980s, and then, of course, a big drop during the Reagan administration and relatively small movements afterwards. But remember that this is the share going to the top 1% pre-tax, so there is no mechanical effect of taxes on those top incomes, and yet it's striking when you see that graph, they really look like mirror images of each other. You know, the correlation is strikingly strong. So in the case of Canada, I've put together, you know, the same chart for Canada. Canada also used to have very progressive taxation. Actually, Canada has a fall in top tax rate significantly before the United States. And yet you can see that top incomes, they really have to wait till the US top incomes increase, so it doesn't follow the tax system as closely in Canada, suggesting again, you know, that the cause in Canada is mostly driven by the United States. The other thing I want to mention is that this evidence that I've showed you for the US also carries over in the international evidence. So here, let me show you first this graph. So this is the world in the early 1960s. In terms of country, so each dot is a country. Here you have on the x-axis the top marginal tax rate, and on the y-axis the top 1% income share. So the world in 1960 looks like countries have pretty different, you know, levels of top tax rates, with strikingly the US and the UK being the most extreme in terms of having very progressive taxation. You know, as Thomas Piketty likes to say, the US invented very progressive taxation, and they really loved it, you know, for a very long time. You can see that Canada also has a pretty high level, above all three countries, you know, above France. And all countries have relatively low top income shares in the 1960s. Push forward 40 years, and you can see that all countries have moved to the left and up high, meaning that all countries have reduced their top tax rates, although not to the same extent. You know, the US and the UK have traveled the biggest distance from here to here, and a lot of countries, particularly those who cut their top tax rate the most, had big increases in top income shares. So countries have moved up on this chart, so that if you bring together that evidence that is here, you put by how much the country cuts its top marginal tax rate, and here by how much, you know, top incomes increase, you can see that there is a very big correlation. You know, the US and the UK being the biggest cutters of top tax rates and experiencing the largest increases. Okay, so you can see that more or less the countries align along diagonal. So all that evidence to say that we have pretty strong evidence that indeed pre-tax top incomes are affected by top tax rate. I'm not saying that that's the only thing, you know, that matters for top incomes, but there is a strikingly strong correlation in the data. So now there are three potential scenarios that can explain this strong link between top tax rates and pre-tax top incomes, and they have very different policy consequences. So the first story would be a supply-side story, whereby top earners work less and therefore earn less when top tax rate increases. So if that's the scenario, then top tax rates should not be too high, because you destroy economic activity if you tax, you know, people and they work less and therefore they produce less. Okay. The second scenario would be a tax avoidance evasion scenario, whereby top earners avoid or evade more when top tax rates increase. Now, this scenario is very different from the first one, because in the first one, there's nothing the government can do, you know, to prevent people from working less if they are taxed more. In the tax avoidance evasion scenario, it means that your tax code is not well designed. But the fix is really to eliminate loopholes, you know, tax avoidance opportunities, and then you have the ability to increase tax progressivity. Now, the third scenario I want to mention, which is a much more radical scenario is the idea that top earners are able to extract more pay at the expense of the rest of the economy, so namely the 99%, when top tax rates are low. So what is the idea there? The idea is that CEOs may have influence, on their pay by influencing, the boards or the compensation committees, and a CEO has a much stronger incentive to push, and to spend effort at increasing their pay when top tax rates are low, because they get to keep, a much higher fraction of their earnings. Okay, and so if that's the scenario, then indeed high top tax rates are desirable as a way of preventing the very highly paid, from exploiting further the system. And I should say, that really the US, the UK, and Canada must have believed in those scenarios at the time, they had those super high top marginal tax rates. Otherwise, it really, from an economic point of view, it doesn't make sense to have such high marginal tax rates unless you believe, that the very wealthy or the very talented, in the case of labor income, are going to be able to exploit the system. Now, in which scenario are we in? Okay, so that's a fundamental and difficult question to address. So I'm not going to be able to totally prove it one way or the other tonight, but I just want to show you some evidence that points us, towards one direction rather than another, and get your reaction. So let me first talk about real changes versus tax avoidance. So inequality deniers sometimes tell us, look, you've assembled this nice data set here about the top 1% share, but this doesn't tell us anything about inequality because it's all about avoidance behavior. Namely, the reason why you see that top incomes in the US were low then, it's because, look, the tax rates were so high that the high incomes were finding ways, to hide their income from the tax authorities, either by avoidance, evasion, etc. And then when tax rates were low, those incomes showed up. So how can we disprove such an argument? One way you can see it pretty simply is to look at charitable giving behavior of top earners. Because charitable giving is tax deductible, the incentives to give are actually stronger when tax rates are higher. So that means that if those people in reality, here in the 50s and 60s at really high incomes, they should have given like crazy because the tax rates were really inducing them, to give, and according, to the inequality deniers, they had the money. So let's look at how charitable giving has evolved. So in this chart, I show you charitable giving of the top 1%, from the 60s to the present, and it's measured relative to the average income in the economy. And so in the 60s, the rich were giving about a third, if you want, of the average income, which is a large amount, but keep in mind, that they had very high, their incomes allowed them, to give as much, and you can see very clearly that charitable giving of the wealthy has increased a lot, so that today they give about 80% of the average income. And if you superpose that, so sorry, the chart is a little bit ugly here, but when you superpose that, with the triangles, with the level of the top 1% income share, you have an almost exact parallel line. So what the data says is that basically the top 1% has been giving pretty much, all over that period about 3 or 4% of their income. But as they got richer, according to the tax data, they were giving more. So that strongly suggests that actually they were really richer, not just richer on paper. Because if they had been only richer on paper, they shouldn't have been able, to give more. So that's perhaps, the simplest way I can disprove the hypothesis that the trends I've shown you, are due to tax avoidance. What can I say? So if it's not tax avoidance, at least in the United States, for the recent period, that leaves us with the two starkest scenario, the supply side scenario that tells us, taxes are bad because they cut down effort, versus the rent seeking scenario where taxes are good because they prevent, the high incomes from extracting more from society. So it's also the hardest one to prove one way or another, but let me show you some striking evidence, again, coming from the United States. So what I've done on this chart is that I show you how the incomes of the top 1% in black diamonds and the bottom 99% in empty diamonds have grown over time, over a century, from a base 100 in 1913, and here you track, average income per adult over a century, and then by the end, a century later, all those incomes are higher. They are at about 400. So in other words, economic growth in the long run lifts all boats. Incomes, real incomes per adult are multiplied by 4 over the course of a century. However, that's true in the very long run. In the medium run, you have very different time patterns of growth. So namely, if you start, at the New Deal in 1933, you can see that up to the late 1970s, bottom 99% incomes grow very fast. They go from less than 100 to 300. In contrast, top 1% incomes grow very slowly. And that's precisely the time where top tax rates are extremely high. So you can say this about top tax rates, very high top tax rate, at least in that period, certainly didn't prevent the vast majority, namely, the bottom 99%, from doing very well. Now, after the 1970s, you can see that the pattern reverses itself. So then bottom 99% incomes are growing very slowly over that period, of 30, 40 years, while top 1% incomes are growing extremely fast. And that's precisely the period where the top tax rates have come down very significantly. Okay, so this chart is striking because it does, it is indeed, consistent with the idea of rent seeking. That is, when top incomes are prevented from extracting a lot, by a very progressive tax system, they grow slowly, and the gains of growth go mostly to the bottom 99%. When you change that pattern, you have, the reverse happening in the United States. So now, it doesn't prove rent seeking, because it's possible that the economy has changed in a way that now, the top becomes much more productive, and we don't need really the bottom 99%, which is also a worrisome scenario to be in, but that would be one that's perhaps harder to address in terms of policy, while the rent seeking is easier to address with tax policy. And so the last thing I want to mention, those numbers that we put together with Thomas Piketty have caught more and more interest in recent years because the trends have been so extreme. So that is, why are we interested so much, in what happens to the top 1%? We are interested, those numbers matter because they really affect the way you are going to interpret economic growth. So for example, the Great Recession ends here in 2009, and after that, GDP growth has resumed. But you can see on this chart that it's stagnation, really, for the bottom 99%, and really virtually all of the growth goes to the top 1%. So if you see a growth number, more, growth of 2%, per adult, really for the bottom 99%, that is the vast majority of people, it doesn't look like a 2% growth. It looks more like a 0.5% economic growth. So the fact that inequality has changed so quickly has created a disconnect between overall economic growth, GDP that people look at and commentators discuss all the time, and what's really happening for the vast majority of the population. So let me conclude with this slide. So the US and international evidence shows that tax policy plays a key role in shaping inequality. I really believe that the natural state, if you want, of capitalist economies is to have high levels of inequalities. Now, governments did something radical, which was the development, of progressive taxation and many other things that lowered that level of inequality. Those gains have been lost in the United States, and they are being lost in other countries. We know historically that high top tax rates are successful in reducing, income concentration, certainly without visible effect on economic growth, at least in the historical record. Now, from that, you would say, so it's a no-brainer, that we should have more progressive taxation. I think actually it's harder. It's not as easy as that. That is, I really think that societies can live with high levels of inequality for a very long time. So the French Revolution was 1789. It took more than 1 century before France started doing really progressive taxation. Same with the United States. It's really dramatic events like the World Wars that prodded countries from changing radically their tax system. So I really believe that the public will favor more progressive taxation only if it is convinced that top income gains are detrimental to the 99%. And even if the public is convinced of that, it's not totally clear that that would be enough. Now, in a globalized world, and perhaps we can discuss it, progressive taxation will require international coordination to keep tax avoidance, evasion low. And so that's particularly important perhaps in the case of Canada. If Canada wanted to clamp down on the surge of top wage earners, progressive taxes would be one option, but one thing they might do is perhaps to induce a lot of those highly paid executives, to migrate to the United States. So that's why at a one country level, especially if the country is small, and affected, by what others do, it can be a difficult thing. So let me stop here and thank you very much.